Hi. In this video, I wanted to quickly walk through how you can think about valuing your business. This video is really for business owners or business brokers or anyone that's just kind of curious on how, as a business broker, I value a business. And I'll do the really short version first, hopefully in 30 seconds or less, and then I'll go into a lot more depth after that. So the very short answer is your business is worth what someone is willing to pay for it. I know that seems very obvious, but if you have in your mind your business is worth X, but no one will pay for it for that price, then it's not really worth X. Maybe it's worth it to you for that price, but not to anybody else. So at its simplest form is how it works. Other times someone really wants this particular business for maybe a strategic reason, and maybe it's over market price, but it's worth it to that individual. So you really don't know what your business is worth until you sell it. But as you're trying to think about a price and how to go about thinking about the price, really what you're going to do is you're going to look at your profit and loss statement, your tax return, and you're going to calculate seller's discretionary earnings if your business is likely to sell for under $2 million. So seller's discretionary earnings is just all of the cash as the owner that you have the benefit from the business. So that would include your salary. Say you take $50,000 in W-2 wages. Say you earn $50,000 in profit, and maybe you would take $10,000 in sort of write-offs for a personal vehicle and personal cell phone that you charge through on the business. So that's $50,000 W-2, $50,000 profit plus the $10,000. That's $110,000 in seller's discretionary earnings. At the simplest form, we'll go into more depth. But so if you're making $110,000, that's what the new owner can expect to see from the business. Then that 110 is multiplied by something in order to calculate the overall value for the business. So in a smaller business, under 500,000 as a sale price, you're looking at a 2 multiple. That's according to the IBBA, International Business Brokerage Association. They do tons of surveys. 2 multiple is sort of where it's at. I also pull comps, and I'm going probably too far in depth at this point, but essentially it's your cash flow from the business times a multiple equals the potential sales price. As you get to be a bigger and bigger business, over 2 million in profit every year, then people are probably going to look at the multiple more on an EBITDA basis rather than seller's discretionary earnings, because they're figuring that there is a management team in place. It's not necessarily the owner operating the business and that being the way it looks. So that is the short answer. So let's walk through a little bit further about into the details. So I talked about how you calculate seller's discretionary earnings. One thing I want to note is you're going to look at your profit and loss statement. Those are through QuickBooks or internally prepared statements, and you're going to add back, there's certain things that always can be added back and that are accepted by the bank. So those would be things like if you pay any income tax through your business, if you have any depreciation, amortization, if you pay any interest on your loans or financing, if you make retirement contributions for yourself that benefit you as the owner, if you pay yourself a salary out of the business of W-2 wages that's expensed on your profit and loss statement. Those are all things that can be added back, including the payroll taxes that you're paying for yourself. So that's typically what the bank allows for when they're calculating seller's discretionary earnings. Now, a lot of business owners run some level of personal expenses through their business. That's just the reality of the situation. And it's one of the benefits of owning a business to a large degree. So think about if you are a daycare, say, and you are, every time you go out to dinner with your wife, maybe you and your wife own the business together, you might talk about the daycare, and so you just put that restaurant bill on the business, and on your profit and loss statement, it shows meals and entertainment, and maybe you've spent $5,000 worth of meals and entertainment, but as a daycare, you're not taking clients out to entertain them at restaurants. So as a business broker, we might say, let's add that $5,000 back, because that $5,000 in restaurant charges is not something a new owner is going to incur. So we can think about adding that back, and as long as there's a reasonable explanation that the new buyer is going to accept, it's reasonable. This is where there starts to be some level of judgment involved, because if you can't justify it to the new buyer, it sort of doesn't exist. So I've sold businesses where, for example, it's a roofing company, and yes, they buy a lot of products at hardware stores. So think, the Home Depot bill, or, other construction suppliers. And so there are legitimate business expenses on the profit and loss statement related to those expenses of buying materials. Well, maybe as an owner, you're going to remodel part of your house, and you think, well, I'm just going to put this on my business credit card, this personal expense for my house remodel. And I'm going to put it in the materials section of the profit and loss statement when I expense it. Well, then it becomes a lot harder to parse out, okay, some of these material expenses on the profit and loss statement are legitimate. Some of these are personal. And if you don't have really, really good records showing which is which with receipts and other things, a buyer is not just going to trust you when you say, oh, 30,000 of that material on the profit and loss statement is actually just personal. Because you could just be saying that. I mean, that's a really easy way to kind of cheat your valuation. So if it's all sort of mushed together, I think it's difficult to add back unless you have really good records. If it's something that clearly the business doesn't need in order to operate, or it's a one-time large expense, then it's a lot easier to add back. So an example of a large one-time expense that I've added back to a business in the past is it was an irrigation company, and they had a truck that was in a pretty bad accident. So they had a large insurance amount that they had to pay out. They paid out some workman's comp. They paid for some equipment that was damaged. And so maybe all in, it cost $40,000 for this accident that happened. Well, that shouldn't happen. That had never happened in the history of their business. It won't likely happen again to the new owner. So it was reasonable to add back that $30,000, $40,000 worth of one-time expense that was incurred, and it's really easy to show and prove that to the new buyer. So that's kind of a little bit about add backs. The other thing I would say is that the bank is mostly going to go off of your corporate tax return and what amount of income you're showing there. So for example, if you show $3 million of revenue on your profit and loss statement, but you only claim $2 million of revenue on your corporate tax return, what happened with that other $1 million? Is that, you could put anything you want in QuickBooks. You could say, yeah, we got $1 million, but so a lot of times buyers and banks are using the tax returns to validate that the internal profit and loss statements are accurate, because no business owner wants to pay any more tax than they have to. So they are going to report the numbers and report them conservatively. And that's how the bank wants to look at the numbers as they decide whether to loan on a business or not. The other thing on tax returns that I've seen is, sometimes there's just discrepancies between, large discrepancies between the profit and loss statement for whatever reason in the tax return. So as long as they're pretty close, you can kind of go off of the internal profit and loss statements. If they're really far apart on what the net profit is, you sort of have to dig into that and figure out what's going on. And likely the bank is going to use more of the corporate tax returns on, deciding how much to loan to someone, like I mentioned. So that starts to be where more of the value is. So as a broker, when I'm asking for information from the business owner, typically I'm asking for their profit and loss statements, their tax returns, what their W-2 payroll amount was, and a lot of times business owners get this confused because often they're paying, they're depositing some amount in their checking account, and some of that's distribution, some of that's W-2 payroll, and they don't really know the difference. So sometimes, if you want to just run a payroll report for the last year and see if you were paid any W-2 payroll, that can be helpful. Or look at your W-2, or even look at owner's compensation on your tax return. So yeah, I'm asking for, if you don't know the number off your top of your head, maybe some sort of payroll report showing what amount you were paid in W-2 wages. And then I'll also ask for any one-time expenses that you incurred. So that's the information I need as a broker. What I will then do with that is I will go and look in some of my comp databases. So it's not that dissimilar from real estate, where, to decide the value of your house, appraiser is looking at other houses like yours that have sold in the area for around the same size house. Same thing on how I'm looking at comps. There's a database that I pay for every year, about $500 a year, that has all of the SBA loans that were done for small business acquisitions. So you can see this business was acquired for this price on this date with this bank in this location, and here was the revenue, here was the EBITDA, or the seller's discretionary earnings for this business, and here was the furniture, fixtures, and equipment amounts that were included in the sale. So then based on that, you can say, all right, show me comps for, maybe the last couple of years in this particular industry. And then I'm looking at businesses that are similar in size in terms of revenue and seller's discretionary earnings to your business, because that's a really good sort of benchmark. They call it the comparative market analysis. Your business is likely worth what other businesses have sold for comparatively. So I will grab both a multiple on seller's discretionary earnings and a multiple on EBITDA. The other source that a lot of times people are using for comps is something called the Business Reference Guide. They put out a huge book and also an online format that gives, for different industries, what are some rule of thumbs in how those businesses are valued. Different industries value differently. Sometimes really asset heavy businesses are valued a little bit differently than businesses where it's a service-based business. And so they kind of give some indications as to what the rules of thumb for that particular industry are, how a lot of buyers are looking at it. They also give some different rates at metrics at different size businesses. So for maybe businesses that sold under 2 million, this was the multiple that they went for. So once I have those comps, I can get just a benchmark. So say your seller's discretionary earnings was 200,000, and the comps that I pulled show me maybe a 3 multiple. Then you just take the 200,000 times 3, and that's where you're going to get your 600,000 in business value. So that's just a starting point, 600,000. The thing to keep in mind is that when you're looking at the comp databases, only the most desirable businesses with clean financials that the bank likes, that have a reasonable track record, yada yada, those are the only ones that are getting SBA loans. So if your business does not look like that, in that maybe it's not been in business for 3 years, maybe your financials aren't super clean, you're adding back a lot, maybe there's some problem that's happening, significant problem that's happening in your business is probably not going to be worth that same 3 multiple that the other businesses sold for. So we have to make some adjustments based on desirability. And when you're looking at what makes a business desirable, one of the biggest things is the size of the business. So I know this is sometimes hard to wrap your head around, but when you think about, put yourself in the buyer's shoes. Would I want to take on a loan take on the stress of owning a business, take on the risk, if at the end of the day I'm going to be paid $50,000 or $60,000 and I have to work in the business? Essentially, you've bought yourself a maybe riskier, higher stress job with a big loan on the line too, where you're going to make $60,000. Well, at that point, buyers start thinking, well, I should probably just get a job. I could have $60,000 and maybe I have more benefits, less risk. I don't have to fund a big loan. I don't have to put a lien on my house to cover that SBA loan. So when you look at those smaller businesses that at the end of the day, after the business owner gets their profit and then pays off their annual debt payments on their loan, if that amount is under $100,000, people start thinking it might be a better idea to get a job. Not that you can't sell your business, not that there's no one that will buy it, but it's just going to go for a much lower multiple than a larger business. So let's look at two irrigation companies, for example. One that the owner is going to make $60,000 after, in profit minus their loan payments, $60,000. That business might go for a 2x multiple. Now look at a business that the owner is going to make $400,000 in profit, and then they're going to have their loan payments. So maybe I could do the calculation, but maybe let's say $100,000 in loan payments just to be really conservative. Well, that owner is going to get $300,000 a year for operating that business. Which job would you rather buy? The $60,000 job or the job where you're going to make $300,000 a year? Obviously, everyone wants the $300,000 a year job over this one. So that makes that larger business more desirable. More people want that. And because of that, that increases the multiple. So while this irrigation business might have sold for a 2 multiple, this one might be selling for a 2.8 multiple or a 3 multiple. So that the size of the business really matters. And for the IBBA puts out a survey. They survey all the business brokers, see where transactions fell and what multiples things fell at. And these numbers have been remarkably stable. If you're selling your business for under $500,000, and that's what the value is, you're going to see a 2 multiple. In general, according to the IBBA, from $500,000 to $1 million business sale price, those are typically going at a 2.8 multiple on average. Some higher, some lower, but on average, if you're selling your business for $1 million, it's on a 2.8 multiple of seller's discretionary earnings. Same with if you're selling your business between $1 million and $2 million, that's at a 3 multiple. And once again, that's at a 3 multiple of seller's discretionary earnings, not EBITDA. Because when you're buying a business for under $2 million, most of the time you're going to be the owner operator. You are going to work 40 hours a week in that business, 30 hours a week in that business. You're not just owning that business as an investment where you're not doing anything. Once a business is a lot larger, that's when you might look at EBITDA. So in a business that's between $2 million sale price and $5 million sale price, that on average is getting around a 4 multiple, according to the IBBA market report. So, and then you can see as you get even larger, at a $5 million sale price to $50 million, that's a big range, I know. But multiples can be anywhere from, on average, it says 5.3, but it could be anywhere from 5 to 12 to even 20 multiple. I mean, once you get in that larger range, the multiples really, really increase on an EBITDA basis. So, that's just kind of gives you some sense of how drastically the multiples change. And when you're looking at seller's discretionary earnings as the most important thing in your business versus when you're looking at EBITDA. And really, if you think about it, the only difference is if my seller's discretionary earnings is I'm working in the business, I own and operate this business, and I'm making $200,000 in seller's discretionary earnings, okay? But if I wanted to replace myself and I didn't want to work in the business anymore and I needed to hire someone off the street that I could trust to run my business and run this size of operation, maybe I'd have to pay $120,000 to a new employee to come in and do my job for me. So then if the seller's discretionary earnings was $200,000, then the EBITDA is that $200,000 minus the $120,000 that you're going to have to pay at market rate. So the EBITDA is $80,000. So that's kind of the difference. So next, we've talked about size. There are other desirability factors that need to be adjusted, and some of this is a little bit more of an art than a science, and it's important to work with, a broker that you trust, that is experienced, that knows what they're doing, so that they can make these adjustments appropriately. But as a broker, I am looking at what are the revenue trends. If a business is growing year after year, or if it's steady year after year, that's clearly a more desirable business than one that is in decline and that doesn't have a lot of explanation as to why it's in decline. So maybe it's a tanning salon, and maybe back UV tanning used to be maybe more popular. Now people are starting to get more and more worried about the dangers of tanning. And so that industry as a whole, UV tanning, might be kind of going down. Yes, there are still people that are going to do it, but the industry as a whole is shrinking. That is going to be less desirable for a buyer to buy, clearly. Next is, how long has the business been in business? If the business has been around for 30 years and it's very stable, that's clearly more desirable than a business that's been around for 2 years or 3 years or 4 years. The role of the business owner is also important in the valuation. So if you are owning a plumbing company and you are the master plumber and you do the plumbing work, and maybe you have 2 other plumbers, it's going to be harder to find someone to buy your business that is a master plumber. There's just less of them than business people out there. So if your role in your plumbing business is you just sort of oversee it, you run payroll, you help with hiring, that's going to be a lot easier business to sell than one where you are doing a very niche role in your business, and it's going to be hard to find someone that can do that role exactly like you do. The other one to think about is if you are doing the sales in your business. Even if there are a lot of people that can do sales, if you are the only one selling in your company, and say maybe think about my business. If I am I have First Choice Business Brokers, I own Nebraska for First Choice. But if I'm the only person here, even if I'm making a good living doing this, is someone else going to be able to do it exactly like I am? Are they going to have the same relationships that I do? If it's a lot based on my personal network and my personal brand and my skills, and I'm the one doing all the sales, it's going to be harder to sell that business. So that also matters, that an adjustment really should be made based on the owner's role. Recurring revenue versus project-based. Clearly, if you have most of your revenue coming in on a regular recurring revenue basis, every single month a person's card is being charged, that's more desirable than a lot of project-based revenue. If you have contracts into the future, that's more desirable than if you don't. Whether it's a simple to run business or it requires a lot of heavy training or expertise. So, if it's going to be easy for a new person to get into this industry, understand how it works with a couple of weeks of training and take over, or you have a lot of employees in the business that can really help, then it's going to be worth more than if that owner needs to come in with a lot of technical know-how. Next is the employees. If you have a lot of great long-term employees in the business, that's excellent compared to I looked at a business recently where over the last year, they've hired 40 part-time employees, and they, keep them on average maybe 3 to 6 months. Well, that's a lot of work on the owner's part to hire all those employees versus, a couple long-term stable employees. And then last, I would say, looking at the assets is important. So if you, let's say you are a roofing company and you subcontract all your work out, you don't have many employees, you don't have many assets, maybe you just have a truck or two, that might be worth a little bit less than a business that, say, is a manufacturing firm that owns $1 million worth of equipment and $500,000 worth of parts. Yes, they might be doing the same amount of seller's discretionary earnings or EBITDA, and that is way more important than anything else. But still, you might get a little bit of a bump if you have a lot of equipment, you have a lot of inventory, that sort of thing. You're going to get a little bit of a bump over this person where it's mostly just goodwill that the person is buying. They're not buying physical assets. So after I've looked at everything, found the comps, made all of those adjustments based on size and desirability of the business, then I'll have a number. So say I think your business might be worth, let's just call it, I'll use a real example. I'm going to pull up actually my screen. So say I come in and say, I think this is worth $475,000 is what I think the business will go for. I'm going to do what I call an SBA financing test, or like a sanity check for myself to say, okay, if I'm saying the business as a broker is worth $475,000, let's look at how the bank is going to look at it. And the bank is kind of black and white about how they look at, here's how much money the business is making, here's how much the debt payments will be, what is the ratio between those two things. Clearly, they don't want to have the business making $100,000 per year in profit and the debt payments to be $100,000 a year, because that's really tight. If the business goes down at all of a sudden you can't make your loan payment. That's a big problem. So they want to typically see what they call a debt service ratio of 1.2 and higher. Sometimes people can get down to like 1.15. I would say that's more on the extreme if you're acquiring another like kind business. But 1.2 is sort of the typical lowest they'll go with a debt service ratio. There's 1.4 is more comfortable, 1.5 is even better. Over 1.5 debt coverage ratio is really desirable. So what I'll do is I will basically back into, all right, if the business purchase price is $475,000, if the SDE for this particular example is $96,000, and the buyer's cost of living, which is another thing that the bank will look at, and they will look at it based on that particular buyer. So if that particular buyer, maybe they have a spouse that makes W-2 income and covers all their needed wages for their household. They have no debt. Maybe the bank would say, okay, you just need, let's call it $15,000 in buyer's cost of living that we're going to allocate to say that's what that would be. In this case, if I look at a 90% financing, so the seller is going to put 10% down, and if I give it an 8.5% annual interest rate, which would be a really good interest rate right now in 2024 for a local bank, 10-year loan period, the annual loan payments on that $475,000 business, you're going to be paying $71,000 to the bank every year. So what the bank sees is a debt service ratio of 1.15. That's a little tight. A lot of bankers probably aren't going to like that. 1.15 isn't very good, because that means that there's only $10,000 available after you pay for your financing. And the owner's salary in this case for this business would be $25,000. None of that's very good. And I start to do the check of like, who is going to want to buy a job, pay $70,000 in debt, and only make $25,000 in their pocket? I think that's going to be hard to sell. So even if I thought like technically on a comp basis, it should be this, should be that, it's probably not really worth that, because who's going to do that? So let's start playing with the numbers a little bit. I might say, okay, well, what about $350,000? At a $350,000 sale price, all of a sudden your debt coverage ratio goes up to 1.5 now. So the bank's going to like it a lot more, and your owner's salary is $42,000. Still not great, but it's a, maybe if they were buying this business as an add-on, or maybe if they didn't have to have as much of a direct involvement, this would make sense. You can also just see where on those smaller businesses, it's harder to get those financed, because the bank is looking at, here's the loan amount, here's what amount you need for a buyer's cost of living and a salary, and then here's what's left. So if I do maybe a larger transaction, so let's call it a $4 million sale price, and maybe that business is making $1 million a year. Well, let's say the buyer's cost of living is $90,000. Bank looks at all your mortgage payment, your credit card bills, and they say, all right, you need $90,000 to live on. Well, at that point, and let's give it a higher interest rate. I don't know, let's give it a 9.5% interest rate. With that business, that $4 million business that you bought, your annual debt payments are going to be $566,000. So you're not going to get that $1 million in EBITDA. You have to pay debt because you bought a business for $4 million. But after you pay your debt, you are going to have a $433,000 left that goes to you. Hey, that's more desirable. $433,000 in my pocket. Maybe I was making $150,000 at my corporate job, and if I can make $433,000, buy a business that's been around for 60 years with stable income that I think I can grow and make a huge salary, hey, that starts to be pretty desirable. And at this one, for this example I gave, the debt service ratio is 1.61. The bank feels really comfortable because even after you pay your loan payments, there's $343,000 left of available cash flow after you've paid for your financing. So I know I'm just throwing out a lot of numbers right now, but I run all this in a spreadsheet really quickly, so I can play with that purchase price a little bit, and I can also play with the seller's discretionary earnings or the EBITDA to say, yes, I know you think the seller's discretionary earnings is $100,000, but $20,000 of that is add backs I know the bank is not going to accept. So really, when you look at it from a banking perspective, your seller's discretionary earnings is $80,000. Now I can back into what I think will likely cover from a cash perspective, because it is so important to know how the bank is going to be thinking about this, because most buyers are going to buy a business with some sort of bank financing. People don't have $300,000 sitting around to buy a business, full price, and they're only going to be making a little bit off of that business every year. They don't have $4 million sitting around. So the financing piece is really important. And as a broker, and this is one of the advantages of working with a really good business broker, is they have relationships with commercial lenders that do this on a day in, day out basis. Don't trust your local, SBA guy down the street that does one SBA loan a year and it's for real estate. It doesn't even have anything to do with business acquisitions. You need someone that really knows SBA loans well. They do 50 million in SBA loans a year. This is what they do. I have those relationships. Other brokers do too, that are very experienced. And I will run a deal by my lender, and I will have them say, yes, I would be interested in doing this loan at, example, $690,000. Well, that's great. Then I know that I can put SBA pre-approved, which just really means an SBA lender has looked at it and says that that's a good deal, and they've put together a term sheet. So when I'm marketing the business to potential buyers, I put SBA pre-approved, and that attracts a lot more buyers because they they know that they're likely going to be able to get financing. I can also connect them to the banker, so that saves time. So I say, hey, you're interested in this business, here's a banker, he can look at your finances, he's already looked at the business finances, and they'll be able to know quickly if they're going to be able to likely do this loan for you. So yes, the financing is a really important piece of it, and it's a piece that I use kind of as a sanity check at the end. Other things that I would say, just because I'm going into an in-depth video, is working capital matters. Seasonality matters, the industry matters, whether it's in a rural or a city location matters. So for example, if I am running a construction business and I send out my workers on January 1st, but then I'm not paid until the general contractor gets paid, which is in 30 days, and then I'm not paid for another 30 days after that, then I'm having to front labor for 60 to 90 days. That means a new buyer is going to have to bring quite a lot of working capital into the business on day one. They can't just start with their business bank account at zero. They're going to have $300,000, $500,000 sitting in the bank just to cover, that first working capital. Other businesses, business I'm selling right now, she bills on Sunday night to Medicaid and she is paid on the following Friday. 1 week, like clockwork, she bills every single week, paid every single week. That business clearly doesn't have as much working capital that's required in that business. So that matters. As you get further along in the deal, a lot of times a buyer will start thinking about that. So you'll want to think about that in advance. Other things I've seen in deals that I've worked is seasonality. So say it is that construction company and you are in the Midwest, which that's where I'm in. I'm in Nebraska. Maybe a lot of the construction businesses that are working outdoors do the majority of their business between April and November because no one's working on concrete in January when it's 0 degrees out. So when a buyer thinks about buying that business, they're also thinking about how long am I floating until the season starts. A lot of times buyers don't want to buy your business in January, knowing that they're just going to have to keep people on payroll until April when the work really starts. They want to buy that business and have it close in April so they have the whole season to work. So timing does play something of an element in it as the deals get finalized and pricing and all that. Industry matters. So we talked about declining industries as a whole versus kind of hot industries. Also, industries where there is a lot of fragmentation and private equity is starting to get interested in that industry. For example, HVAC. Tons of HVAC companies. There's no one main player in HVAC. It's a lot of smaller companies. Well, there's roll-ups that are happening now where people are buying these, 5 HVAC companies. They're putting them together. They're getting a higher multiple and they're selling to private equity. So if there's a lot of that type of activity happening in your industry, it also will help on the price. Versus if no one's really buying these and rolling them up, that will have that won't be as desirable for someone that's coming in from an investment acquisition strategy and trying to buy a lot. And then rural versus city. So if you are in a very small town in, call it Western Nebraska, there's the fewer people, one, that live there, and 2, fewer people that are willing to move to that area in order to buy your business versus if you're in a more major metropolitan area. Same business, the one in a big city is probably going to go for a higher price. So that's a lot I know that I covered with you. And once you know the value, or you think you have an idea of what the business might go for, that doesn't necessarily mean that is what you should price the business at. There's some strategies around that. And as a broker, I tend to like to price a business a little bit higher, on the higher end of reasonable, not something that's like ridiculous, right? But maybe if I think it should be worth a 3 multiple, we might try like a 3.1, 3.2. See if there's anybody out there, a strategic buyer that just really wants your business. Put it on the market, let it sit for 2 or 3 weeks. And if there's not a lot of interest, then we can lower the price in 2 or 3 weeks. And then go to maybe like a mid-range, but still on the higher end. Give it another 2 weeks, then lower it. It's not like a house where if it's been sitting on the market for 4 weeks, someone's wondering what's wrong with this business. Businesses on average take 10 months to sell from start to finish. So you have a little bit of wiggle room in the front end to play with the price. And then you're not leaving money on the table. A business is worth what someone is willing to pay for it. So if you started out here and no one wants to buy it, drop it. No one wants to buy it, drop it. All of a sudden, there's a lot of interest at this level. That's great. And I'm always targeting to get something under contract within 3 to 4 months at the longest. Because other than that, you start to get tired. It's like if your business has been on the market for a year, it's exhausting talking to different buyers. You have to keep submitting your financials to the broker, because your financials need to be updated. You might just start to get tired of running your business because your head is already thinking about selling. You're not maybe as ambitious as you once were, and then you could start having the business decline. So I think that there's an advantage to trying to sell in that 3 to 4 month, or get under contract in that 3 to 4 month window, because then it might take 90 days to close, 30 days for due diligence, maybe 60 days for the bank to get the financing, and then you close. So then you're looking at maybe a 7-month process from start to finish, which I think is more reasonable. But you still have room to play a little bit with the price. So that's one of the ways that I tend to think about pricing strategy if you have the time. So yes, that's a lot. If you are curious what your business might be worth, you want someone to look at it that is experienced and can look at all these factors. You don't want to try to have to do this all yourself. Please feel free to reach out to me. You can find me online. If you look up First Choice Business Brokers in Omaha or Nebraska, I own the Nebraska office. You can also find me on LinkedIn. If you look up Amanda Kohler or AJ Kohler on LinkedIn, reach out to me there. My email address, aj.kohler@fcbb, firstchoicebusinessbrokers.com. So don't hesitate to reach out if you want an opinion. I'm happy to do that for free. I do that all the time. Eventually you will sell your business, right? So don't stress if you think maybe I want to sell in 3 to 5 years, I want to know what it's worth. I'm happy to look at those numbers for you. Or if you think maybe I want to sell it this year and you are on the fence, I'm happy to do that valuation, and that might help you decide whether now is the right time or not to sell your business. And if you are interested in selling your business, that's what I do. So I can do all of this for you. I put together a comprehensive marketing package. Everything is confidential. I deal with all the tire kickers, so you don't have to deal with those folks that are just not serious buyers. Lots of advantages to working with a broker. I can help business owners in most states. There are some states where I can't, because you have to have a real estate license in that particular state. But I do have a wide network all over the country through First Choice Business Brokers, of brokers that I know and trust, and I know you would be in good hands with. So reach out to me. I can either help you myself, or I can put you in contact with someone that can, for either evaluation or just to know a little bit more about selling your business. So thank you guys so much for listening.